With the market heading higher, there have been more and more warnings about an impending crash. JP Morgan has called the recent rally a little irrational. Vanguard is predicting much lower stock market returns over the next 10 years. GIC has warned about the growing risk of an AI bubble. And even legendary fund manager Paul Tudor Jones says today's market reminds him a lot of early 1999, right before the dot-com bubble crash. In this video, we will break down what's really going on. Why are so many people warning about a market crash? What the data actually says? And whether you should be worried or just stay the course. To start, let's look at the numbers because that's where most of the warnings begin. By almost every traditional measure, the stock market looks expensive now. Take the Shiller-Cape ratio for example. It compares stock prices to long-term earnings, and right now it is sitting at one of the highest levels in history. Historically, whenever the Cape ratio reaches this point, major pullbacks often follow soon after. Meanwhile, the buffer indicator, which measures the total value of the stock market relative to the size of the US economy, is also flashing red. It's currently well above its long-term average, suggesting that the market as a whole is significantly overvalued. JP Morgan's research paints a similar picture. They found that when the S&P 500's price-to-earnings ratio reaches these levels, the next 5 years of annualized returns tend to hover close to zero. In other words, the higher the valuations climb, the harder it becomes for future returns to keep up. And to make things even more interesting, the market has become far more concentrated at the top. Today, the 10 largest companies in the S&P 500 make up almost 40% of the entire index, the highest concentration in decades. With so much weight resting on so few companies, the stakes are higher than ever. If even a handful of these giants stumble, the entire index would feel the impact. And lately, there have been a lot of circular deals going around. Nvidia invests in companies like OpenAI, which then spends a large portion of that funding back on Nvidia's GPUs. OpenAI in turn partners with Microsoft, which runs its cloud infrastructure on Azure, powered by Nvidia chips. Then you have Oracle teaming up with Nvidia to expand their AI cloud offerings, and AMD trying to get a slice of that same pie with OpenAI. On paper, this all looks like growth. Companies reporting booming demand, rising revenues, and expanding partnerships. But when you trace where the money actually flows, it often loops within the same small circle of firms feeding on each other's narratives. It's starting to feel a bit like an echo chamber of optimism, where everyone's success depends on everyone else continuing to believe the story. Now, this isn't to say that AI isn't real or revolutionary. It absolutely is. But when valuations start being justified by future expectations that all hinge on one another, that's when bubbles can often form. Quick pause, get up to $280 worth of Apple shares plus up to 3.5% interest bonus per annum when you sign up to Webull. With Webull, you will enjoy some of the lowest trading fees in the market, starting from just 50 cents per order with zero platform fees on US stocks across both regular and extended trading hours. And if you often trade a large amount, you can also switch to the fixed commission plan to cap the commission fee to just 90 cents per order during the promotion period. For options traders, Webull now lets you trade advanced option strategies at only 55 cents per contract, again with zero platform fees. The platform also comes with useful features for both new and long-time investors, such as advanced charting tools, real-time news, analyst ratings, and in-depth technical and fundamental analysis. New users who sign up to Webull can receive up to 280 SGD in rewards when you deposit a minimum of $10,000 and keep the funds there for 90 days. On top of that, with Webull's interest bonus, when you deposit 10,000 SGD and above within 30 days of your first deposit, you will get to earn an interest bonus of 1% to 2.5% per annum for 180 days. Plus, complete 6 eligible buy trades during those 180 days to unlock an extra 1% interest bonus. That's up to 3.5% per annum total interest bonus on your SGD funds. So if you are interested, do sign up to Webull using my link down below. Now, let's get back to the video. However, despite all the warning signs, the markets might not crash just yet. First up, earnings. According to FactSet Q2 earnings report, 82% of S&P 500 companies have beaten earnings expectations in the last quarter. This is above the 5-year average of 79% and certainly well above the 10-year average of 75%. Out of the 11 sectors, 9 of them reported year-over-year earnings growth, with the exception being energy and materials. This shows that the S&P 500 isn't solely being driven by the big tech names, but there were also other sectors such as financials and healthcare that contributed to the overall return. Not only that, despite the concerns about inflation and tariffs, analysts haven't turned pessimistic yet. In fact, for the first time since 2021, they've actually raised their forward earnings per share estimates for the S&P 500 by 0.1%. That might not sound like much, but in an environment filled with so much uncertainty, it shows that analysts still expect corporate profits to grow and not shrink. This makes today's market very different from 1999, when prices ran far ahead of fundamentals. Back then, valuations were driven purely by hope and hype, where earnings were stagnant while stock prices skyrocketed. But today, both prices and profits have been moving up together. That's what makes this rally feel less like a speculative bubble and more like a reflection of strong corporate performance. But then, with the S&P 500 being this overvalued on the Shiller-Cape ratio and buffer indicator, surely a crash has to come soon, right? In a way, yes, but it's not as straightforward as it might seem. While both indicators point toward overvaluation, the truth is that these metrics are also a little outdated when applied to today's market. For one, the Shiller-Cape ratio doesn't account for the fact that the companies that we have today are far more profitable as compared to the past. Take the S&P 500 profit margins for example. Back in 2010, the average net margin across the index was below 10%, but today it has climbed to nearly 14%. That's a big jump in profitability. And if we zoom in on individual companies, the difference becomes much more apparent. In 1995, the top company in the S&P 500 was ExxonMobil, which had a net profit margin of 9%. But fast forward to today, the top company is Nvidia. It has a staggering net profit margin of 52%. So, while the Shiller-Cape ratio might signal overvaluation, it's also comparing today's ultra-profitable global asset-light businesses to the heavy industrial firms of the past, which isn't exactly an apples-to-apples comparison. The buffer indicator also has a similar problem. A large portion of the S&P 500 revenue now comes from outside the US, meaning when you compare multinational companies to the US GDP alone, the ratio naturally looks inflated. It's not that the market is necessarily overvalued, it's that US GDP no longer captures the global reach of American firms. However, don't get me wrong, I'm not saying that a crash won't happen. On the contrary, I'm quite sure a crash will come because market corrections are a normal part of every cycle. But the real question is when? It could be tomorrow or it could be 5 years from now. And in the meantime, there will always be someone warning that the crash is coming. Even reputable institutions like Vanguard have gotten this course wrong many times before. Back in 2014, they predicted that the S&P 500 would return just 6 to 7% per year over the next decade. As it turns out, the S&P 500 saw one of its best decades ever, giving around 12% compounded growth rates, despite multiple market crashes, a once-in-a-lifetime pandemic, and a rise in geopolitical tensions. And remember Paul Tudor Jones, the same legendary investor who said today's market reminds him of 1999? He also warned of a major crash back in 2020. Again, since then, the S&P 500 has climbed more than 100%. If anything, this simple chart summarizes the whole thing very well. There will always be someone who will keep warning of a bubble from the start to the end. And when the correction finally happens, they will be like, "Nah, see, I told you it was a bubble." But in the meantime, the market could still go up a lot more. For example, right now the Nasdaq 100 has gone up 6 months in a row. And what they found was that historically, when that happens over the next 1 month, 2 months, 3 months, and 1 year, the Nasdaq 100 has a very good chance of ending up in the green, with the 1 year later giving an average return of 18%. And to drive home the points that all-time highs are completely normal, here you can see that all-time highs occur very often. In fact, since 1950, the US market has seen 1,250 all-time highs. That's an average of over 16 every year. And whether you invest at all-time highs versus any other dates, there's not much difference in returns. If anything, the 12-month return tends to be higher than if you had invested in any other time. Though, market corrections of more than 10% after an all-time high are the highest during the first year, occurring at 9% of the time. But I will still say that the odds are pretty much in the bull's favor. And if you go out 3 and 5 years later, the odds of that happening becomes very low. However, let's just take a step back and ask ourselves, what's the worst that could happen if I take some profits off the table and wait for a market crash? Well, Schroeder ran a back test on this and found that if you switch to cash whenever the previous month end was at an all-time high, you have ended up destroying 90% of your wealth in the very long run. So instead of getting $103,293 return on $100, you would have gotten less than $10,000. And that's the cost of trying to outsmart the market. Our brains are wired to look for patterns, even when none exist. Just like how we expect the sun to rise in the east and set in the west, we assume that after a series of strong years, a crash must come next. But the market doesn't work like that. It doesn't move in neat, predictable cycles, and it definitely doesn't care about what should happen. Over the long term, what drives it is productivity, innovation, and human progress. Because as long as productivity keeps rising, companies continue to find new ways to grow and innovate, and capital keeps flowing into more efficient businesses, the markets will keep moving higher, at least until something eventually breaks in the system, whether it's an economic shock, a policy mistake, or a sudden loss in confidence. That's usually what triggers the next downturn, not the simple fact that prices have gone up for too long. And even when those downturns happen, history shows that markets always recover, often faster than anyone expects. And missing those recovery years can be far more damaging than enduring the crashes themselves. So instead of trying to predict when the next crash will come, the better question is, how can you make sure you are ready when it does? That's why for me, the simplest and often best approach is to stay invested. Keep dollar cost averaging in the solid diversified ETFs or quality stocks and let time do the heavy lifting. If you are worried about a crash, it's fine to keep some cash as dry powder, but don't sit out of the market entirely. Crashes come and go, but over time, staying consistent often beats trying to be clever. Because in investing, it's not timing the market that matters. It is time in the market that makes all the difference. Anyway, that's all for this video. Hope you found this useful. Like, share and subscribe as I'll be posting new videos every week.